So, as you see featured on your screen here, today we're going to be talking about AT&T stock. Now, prior to getting any of that, I just wanted to make a quick mention. Obviously, a lot of companies are reporting earnings today, and I will be making videos on all of them. So just keep an eye out. Any one of the big companies reporting earnings, I will be making separate videos for. So just keep an eye out for that. But today we're talking about AT&T for a specific reason. You want to know why? That is right. Randall Stephenson, current CEO, is stepping down as of July 1st. So the position will be taken over by COO John Stankey. Something smells, and trust me, it's stanky. But he's taken over the job. According to the report, Stevenson retires after 13 years. He will remain as executive chairman of the board until January 21st. Later this year, the board will elect an independent director to chair the board after Stevenson's exit. So that is pretty wild stuff, no doubt. Wow. John Stankey's joining the board of directors as well. Whew, what can I say? So now the question is this a good time to pick up AT&T stock? I think it's obviously a good time to look at it because whenever a CEO changes, the company can really change in a lot of ways, either for the better or for the worse. So I do want to make some comments about why I think this is a positive move for AT&T stock. So let's look at the price here of AT&T stock, $30.54, right? Over the past 5 years, what kind of movement have you seen? Downward movement of 11%. So this is a stock that really hasn't moved all that much, all things considered. Now, there are reasons for it. If you look, this company is currently yielding a whopping dividend of 7% and is a consistent dividend raiser. It's raised its dividend every single year for over 20 years. So this company, or right around 20 years, I should say, this company is committed to that, and I do respect it. That is one thing Randall Stephenson kept on, and it was very, very nice as a shareholder for sure. It's something you look for. But you don't see much capital appreciation over 5 years. Nothing at all. You saw some high points, some dips. Right now, obviously, we have had a recent dip. I mean, if you think about it, since let's really talk about since highs in February, this thing's still down another 21% when the market's only down a solid 16%. And I think it may be slightly unfair for it. I think it got hit a little bit harder than the market did, and I don't think that's necessarily something I think is proper for a company like this, especially on the exit of CEO is very good. So first think about what this company is. So AT&T, obviously you probably know AT&T for the phone service, right? They're a wireless carrier. That's probably the main reason you know the name AT&T. And naturally, of course, they're going to say they're the fastest network, right? But I don't personally use AT&T, but they've got a lot going on for them. So obviously, they've got AT&T, just the service, wireless service. They've got internet, so actually wireless connection at home. So not only you get phones, you get that. They've got AT&T TV, live TV streaming apps, 40,000 on-demand titles. Pretty crazy. But obviously, people, it's definitely the leading company besides Verizon in terms of phones as is. But there's something you maybe don't know about them. They've made some acquisitions. So first off, you have AT&T acquiring Time Warner. Now, this was a pretty big deal. Obviously, $85 billion is a lot. But this is one that I think was a good acquisition. Stevenson made a very good acquisition on this. Very good job. Time Warner's paid off for him pretty well. But I think it's also fair to talk about the ugly. Now, probably one of the worst deals I may have seen in a long time is going to be AT&T's acquisition of DirecTV. Now, not because DirecTV is not a good provider company. The issue with it is $67 billion, and it is not nearly worth that right now. So think about the future of this company. And this is 2015, so streaming already did exist. And they went out and spent $67 billion on a traditional cable company. That is what I would like to call a bad decision. Right now, DirecTV is not worth $67 billion at all. Probably half that. Yeah, it's just an awful decision. It was a bad move by Stevenson. There's no doubt about it, and they're paying the price still because the value of DirecTV only goes down from here. It really only does. As streaming becomes more prevalent, DirecTV and these cable providers they're gonna get the cord cut. If you look historically, you see plenty of articles every single quarter. They talk about revenue declining 6.1% year to year in terms of video and broadband services, which is your cable. Rough stuff. You don't like to see that. If we look at earnings results, you see a similar story actually. So mobility pretty consistent, but the entertainment group segment down. You don't like to see that. Warner Media segment was also down. Not super exciting for them, but it's just some crazy stuff. Crazy stuff. Yeah, I mean the earnings was not bad as far as that's considered recently, but this is just something to point out what's going on there. It's a company that does have plenty of cash in the balance sheet. As you see, free cash flow after dividends of $14.1 billion, and it shows you the debt that they have paying in terms of maturity. So this company's got a lot of long-term debt to them. There's no doubt about it. As you see, around $10 billion every year for the next 4 years. You don't like to see that. Definitely a bad move by Stevenson. But here we go. Hear me out with this one. The future of this company relies on one thing, and that is this little guy on your screen right here, HBO Max. So this is their streaming service, obviously owned by AT&T. Streaming service is key. This is how they counteract their losses from DirecTV, and they need a successful service for this. And you think about their acquisition of Warner Media. It's pretty big because of the fact that this adds content to this platform, and that's what's going to get people involved. The way AT&T has it now, especially with DirecTV, there's going to be some exclusives on HBO Max, and it won't make this DirecTV acquisition as painful as it has been before. My question naturally is going to be what the exclusives look like. There's going to be shows and movies made specifically for HBO Max. Are they going to compete with like a Disney Plus's Mandalorian, Netflix, and their lovely Tiger King, if that's what we want to say? I mean, is that what we want to compare it to? I don't know. But are they going to have quality originals that keep people involved? Now, you can think of it many ways. So obviously, there's a good chance that this could hurt their DirecTV business even more. More people will cut the cord and start going to HBO Max. But ideally, that'll be a wash. It likely won't if you think about pricing, and there's no way DirecTV probably brings in a lot more because cable's a lot more expensive than streaming services. You're better off having 3 to 4 streaming services as opposed to having a cable bill. It's just cheaper, and you get just as much content for the most part. So, but HBO Max is still the future of this company, and that is where Mr. Stanky, PU, that is where he's going to find success. It's going to be in AT&T's acquisition here with HBO Max. This is major for them, and if he does this well, this company is going to be actually find capital appreciation as opposed to just what they're doing. So the dividend's safe on this company. That's one thing I wanted to say. If we look at what this company's doing right now in terms of valuation, trailing PE of 15, forward PE of 9. This company's trading pretty cheap if you think about it, all things considered. And it's a company that's not really going to get impacted by what's going on. You shouldn't see much impact. In fact, you'll probably see benefit because of this current pandemic. Price to sales of 1.2, price to book of 1.2, just good stuff going on for this company in terms of valuation. And there's reasons why it's valued cheap, because there's not much capital appreciation going on it, so investors don't value it super highly. They do it for the dividend. The dividend's very good. they do well in terms of dividend. I can tell you that. If you look at this company right now, we will take a real quick peek at the dividend on this company, just so you have an idea of what's going on. So payout ratio only 64% on the company, with a yield right now of 7%. That is wild. Dividend growth for 35 years. I was mistaken on how long that was. 35 years dividend growth. Holy cow. So this is a company that's committed to staying with that dividend. And for that reason, I like it. And for the valuation, I like it. I like this company at this value right now. If we look at revenue, stuff like that, consistent growth here. Gross profit's actually grown, and operating income has actually grown as well. So they're still profitable, and they can afford what they're doing. The net income line, that's right, it's not that beautiful. I gotta say there's been a decent decline in net income, but really that's just because they had a really good 2017. You think about acquisitions since then. 2018 they acquired Warner Media, so that's really hurt their net income line. It doesn't shock you at all. So overall, though, things are going well for this company. Valuation's cheap. I like where this company's at right now, and I think HBO Max can be plenty fine for them. My only concern is that they have a consistently dead part of their business. And I gotta be honest, Mr. Stanky probably needs to cut the cord on DirecTV. I think he needs to focus on the future of entertainment, which is going to be streaming. And if he does that, this company will be doing plenty fine. I'm excited to see what this gentleman, Mr. Stanky, has, besides, obviously, hopefully some cologne. But I think things can go well for this company, and I'm excited for it. I'm a shareholder, and I will continue to be. But in terms of buying stock, I think now is a decent valuation to buy the stock at. So I think now is a good time to buy AT&T stock. Hope you enjoyed.